Our market models have improved significantly in the past 4 trading sessions, signaling a shift back towards risk on. However, we will keep a watchful eye on Europe as it faces some key technical tests in the coming days and weeks. As we head into the new week, we have somewhat of a mixed bag. We'll cover and show significant improvements that are discernible and visible on daily and weekly charts. The mixed bag comes in terms of ETFs and regions of the globe that are providing leadership. Leadership's coming from Europe, especially relative to the S&P 500. However, there's long-term resistance that we'll show later in this video, as well as some tired DeMark counts, which is somewhat offsetting the improvement that we're seeing. So we'd like to see how these counts play out. We should have an answer to that in the coming days, possibly weeks. We're adapting already to the improvement that we're seeing, but depending upon how these DeMark counts play out, we'll remain flexible and nimble. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Let's set the stage for what we're looking at here. It's a weekly chart of risk on divided by risk off. This is SPY, the S&P 500, ETF divided by SH, the short. So this is long relative to short, which is exactly what we want to know. Would we prefer to be long, or would we prefer to be short? Discernible improvement took place last week as of the close on November 23rd. Stock market bottomed in the early summer, late spring, between June 1st and June 4th. On this weekly chart of SPY divided by SH, you can see in early June, RSI for this ratio crossed 50 as the market bottomed. Last week, we closed above 50 at 54.7, which is a good sign. The black line is the ratio itself. These are two moving averages here, the blue and the red line. Bottom in the summer, you can see the ratio recaptured the two moving averages, which is what happened last week. The black line closed above the red and the blue, which is a good sign. It's also a good sign when the slopes of these moving averages turn back up as they did here. MACD, we'd like to see at a minimum the histogram show a tick up. We got that last week. Williams percent R, which is momentum. This is the June bottom after the bottom in the stock market. Here's the S&P 500 weekly down here. Here's where the market bottomed, where it went up. Williams percent R recaptured negative 50. We did that last week. We closed at negative 48, which is greater than negative 50 here. We prefer to see this move up in the coming weeks. ADX, which measures the direction and strength of a trend. We had a bullish ADX green over red here in early June. Cross S&P 500 here. Gains in the stock market followed. Last week, green closed above red. All things being equal, that's a good sign. Rate of change for the ratio recaptured 0 here in mid-July. Gains in the stock market followed. Last week, we recaptured 0 on rate of change. This is a daily chart of the silver ETF, SLV, relative to TLT. We can think of this as the ratio of risk on relative to risk off, or the ratio of fears of money printing relative to the fears of bond defaults. When the ratio is falling, that's what risk off looks like. When it's rising, that's what risk on looks like. Last week, again, this is a daily chart as of the close on November 23rd, recaptured this line here, good sign. Better sign, this is the downward sloping trend line signaling risk off that began in early to mid-September. The This is a bullish breakout here for risk. From an indicator perspective, we have the Copic curve turning up. That's a good sign. If we scroll down, and remember the indicators are for the ratio that we're looking at. This is the S&P 500 here. Williams percent R, you can see early August is when a period of risk on began and the ratio moves up with a steep slope here. Early August, Williams percent R recaptures negative 20. Similar look here to this period of risk on. CCI, same thing. This looks similar to this, which is an early period of risk on. If we scroll down a little further, the ratio had a bullish MACD cross last week on a daily chart. We finished out the week with that bullish cross. Early August again is when the ratio picked up. This is what risk on looks like in early August. If we come down here, MACD center line crossed, the black line I should say crossed zero here, roughly close to that. That's a good sign. RSI early August recaptures 50. Last week closed above 50. This looks similar to this period here in early August. Rate of change in early August recaptured the zero line. Last week on Friday the 23rd, we closed above the zero line. This looks similar to the early stages of a risk-on period. This is a daily chart of the S&P 500 index as of the close on Friday, November 23rd. On Friday, discernible bullish break of this downward sloping RSI trend line. RSI back above 50, both a good sign. MACD closed with a bullish cross, full stochastic, recaptured 50. If we scroll down here, numerous trend lines, possible areas of resistance have been broken or recaptured, including this pink line. Here, all things being equal, that's a good sign. You can draw trend lines on CCI. This is a bullish break, another good sign. ADX, green, 26.9 is greater than 26.3. Green over red, all things being equal, that's what you want. We'd prefer to see rate of change recapture 0. Have not seen that yet. Force index popping back above 0. Tricks trying to make a bullish turn. Here, accumulation distribution turning back up. Ultimate oscillator, bullish break of this downward sloping bearish trend. Williams percent R has moved above negative 80, above negative 50. We'd like to see it recapture this area above negative 20. Look more like this. PPO, like MACD, has a bullish cross as well on the daily chart of the S&P 500 index. While there's no question we witnessed discernible improvement on numerous charts last week, it's good to be aware on the weekly chart of the S&P 500 as of the close on November 23rd, this trend line here acted as support, resistance, somewhat of a stall in here, resistance. It's back in play and could act as potential resistance. From a bullish perspective, we closed last week at 1409, above 1408 and 1406. Next week, we'd prefer to see this chart move into this area here, but again, just good to know that we could bounce back this way, and it's important to keep an open mind. This is a long-term weekly chart for the German DAX stock index going back to 2007. You can see we have a long-term downward sloping bearish trend line that has been acting as resistance for several weeks. How this plays out could be important for all markets, so it's important to keep an open mind about the developments in Europe. Obviously, if we go in this direction, that's good for risk on. If we come down here, we would be concerned about commodities and stocks on a global basis. This is a daily DeMark chart of the FEZ ETF, or the Euro Stocks 50 ETF, DeMark charts and indicators are proprietary tools from Market Studies, LLC. Quick point. Said we were concerned about potential long-term resistance on the chart of the DAX. You can see this is a daily DeMark count for FEZ, European stocks. We have a 9 and a deferred 13. This asterisk tells you that the 13 count here is deferred. To get this 13, we need to exceed the close on the 8 bar. The close on the 8 bar for FEZ is 33.03. And you can see that's not far away from where we closed on Friday the 23rd at 32.60. Point of the exercise: how European stocks and this ETF react to a possible 13 here could tell us a lot about risk in general. If the 13 is a good exhaustion signal and we get reversals, then that downward sloping trend line on the DAX may still be in play. There are numerous European ETFs that have a similar look, whereas if we see continued strength, we will most likely end up with another 9 and a 13, which signals potential exhaustion. Even if the market doesn't reverse, DeMark counts help us with the strength of trends. If FEZ blows through the 9 and the 13 in a bullish manner, it signals to us that we have a strong trend, something that we should respect. This is a daily DeMark chart for the S&P 500 index as of the close on Friday, November 23rd. Big changes last week. A lot of the DeMark counts. Previously, we had an 8 count in this direction. That count was canceled. This is how we look now. We have a 9, a 13, and a 9 still in force. How do I know that? Well, the risk level for this 9 and 13 is still active coming across the screen, and it's at 1492. This is still a potentially bearish count should we get up into this area here. Also, we're on a 4 count now, which says within 5 trading days, we could have a 9, a 13, a 9, and another 9, which would potentially raise some more red flags. We just have to keep an open mind, much like the count on FEZ and that downward sloping trend line on the DAX. We'll just have to see how it plays out. These DeMark counts tell us to keep an open mind about a reversal. Propulsion target at 1447. The downside, it's at 1343. Some good signals. Propulsion, we cleared this green line at 1395. From a momentum perspective, it tells us that this 1447 may now be in play from a probabilistic standpoint relative to 1343 down here. Another good sign, we cleared this TDST level on the daily S&P 500 chart last week at 1403, closing at 1409. Another potential area of resistance is this downward sloping TD line. These are DeMark trend lines that are drawn in a systematic and unbiased manner. If we popped next week, we would run into that line somewhere in the neighborhood of 1427 on the S&P 500 DeMark chart. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.